This book changed my life. I always thought like life insurance and trust and all that stuff was for old people. That was my thought process.
Hey, legacy isn't just for when you're old, because isn't that how we're conditioned to think? And what's interesting is how many people are told to buy term and invest the difference when they're young, and then when they're old, an attorney goes, you need to buy some whole life. And it's like, well, why did I buy it a long time ago when I bought term, when they said I wouldn't need it, and now I have an estate tax problem, and now they tell me to buy it? Here's what it all comes down to: genetic wealth. Legacy, we know that we want to pass on money without tax. We want to create a set of values and guiding principles to support so that it's not just an inheritance, it's a way to perpetuate wealth. But genetic wealth is a big part of this. Our healthy habits, our mindsets, this is all something that Kate Shanahan wrote about in Deep Nutrition. It's just, we've become overly processed and convenient, and it takes to be wealthy and it takes to be healthy a lot more intention and just dealing with the gravity of not just pushing a button and having your food show up. Like, dude, last week I killed an elk with a bow.
When you do it, you just feel like more of a man. Like what you just described, killing your own elk, carrying it back, cooking it up, like that just probably made you feel good. An IUL is like making insurance an investment. It's not an investment. It is a savings vehicle that gives you extra benefits. So if you use an IUL for infinite banking, that does not work. Use what you know is going to work, what's steady Eddie, what you can predict with certainty. That's what you should use for banking.
This is the Mr. Burr Show.
Welcome back to the show, everybody. Today is going to be really just an exciting episode because I am stoked to have the person on that I have right now. He is an author of 10 books, multiple that have actually been award-winning books, including the second book that I ever read on infinite banking. When I learned about this concept in 2020 during COVID, it blew my mind. And then I read Caleb Gwilliam's book, The And Asset. This was the second book I read. And I was like, this is a cheat code. I've got to figure out more about this. So you guys know my story. I went down a rabbit hole. I started watching all the YouTube videos, reading all the books, reading all the articles. Got my first policy May of 2020. End of that year, I had 4. Now I've got 15 policies. And I teach you guys how to use this concept to become the bank and recapture money and stop giving so much to Chase, Wells Fargo, stop paying so much in taxes, all the things you guys know that I talk about. This man that I have on is kind of the catalyst of it all. So I'm excited to have him on and pick his brain. He talks in this book a lot about infinite banking, the and asset, privatized banking, whatever you want to call it, joined up with trusts, how you can use those to really just set yourself up and your family up for perpetual wealth. So I am just stoked to have him on. You guys are going to get a ton of value. And when you do, make sure to share the episode so you can pay it forward. We all grow together. So without further ado, Garrett Gunderson. Dude, welcome to the show.
What's up? Good to be here, man. Good to hang with you.
Likewise, brother. Likewise. So before we just came on camera live, we were talking a little bit about your health. Yeah. Some things going on with that and things you have to do to manage it. So talk about that a lot, because a lot of people think, when you hit a certain level of success and you write some books, they hit the New York Times bestseller list, and you make some money, you build some wealth, all these things, people start thinking like bad things don't happen to those people, only to me, right? So talk a little bit about what's going on with your health.
So long ago, I got diagnosed with polycystic kidney disease, and I haven't really talked about it or even said that I had it, because I was like, look, mentally, I'm just going to deal with this. I'm going to live a better lifestyle. I'm going to manage it. And I've done a pretty good job managing it. And then last year was kind of a stressful year. I divorced a business that I had started and completely, walked away from it. I unwound a partnership, had a couple other things going on. And so it started to show up in my kidneys, because I was doing book tour as well for Money Unmasked. And like, it just really, my blood pressure was really high, like 192. I remember I was getting an IV with 2 of my buddies, Dan and Taylor, and they're like, man, there's something wrong with this blood pressure machine. They're like, it's normal for us. And I was like, it must be me, and maybe I need to start addressing this. So I hired this woman, Deborah, and she did a thing called biofeedback. And then she put me on a very strict regimen of food. Initially, to get my blood pressure down, I took some peptides by a guy, Reagan Archibald. And so I just, I'm really dialed in with what I eat. And I'm really looking at like letting go of stress. Because, to do something like get something on the New York Times or write 10 books, like there's a level of stress involved with that kind of stuff. And so, there's the problems with poverty, right? And the stress that comes with poverty and not having enough. But there's another level of stress that comes with prosperity, the level of collaboration, the level of creation, the level of like just going down a new frontier and trying something new. And so it started to impact my health because in my 20s, I guess I could just push through. But, last year it kind of caught up to me. But the good news is I've been really reversing it. Things are looking really good. And like I told you, one of the byproducts is I'm pretty shredded. I got a sick back. So even ab veins, my youngest was like, dude, you got ab veins? I'm like, I'm pretty lean. And like when I travel, because I travel a lot, I just speaking in New York yesterday, like I just travel with a food backpack. I just bring food along with me so I can have the grass-fed stuff and I can have enough vegetables that, stuff like that. So it's just, it's a lifestyle at this point.
I love it. I actually have a tattoo on me that's lifestyle, and it's got some weights, because a lot of people think there's like a shortcut to everything. Everyone wants that magic pill. They want that magic pill to start making more money. They want that magic pill to lose weight. They want that magic pill to have a better marriage, to have a better relationship with their kids. There is no magic pill, guys. It is doing the little things consistently, day in and day out. To get in shape, you have to consistently eat well, right?
Yeah.
That's the only way that you get ab veins. And it's so funny, man, because I don't think I've ever heard anyone say ab veins, but yeah, if you have ab veins, you're lean.
Yeah, we were working out in Austin. I took my son to a young riders course, and they had a gym that was just me and him in there. So we took our shirts off, and he was surprised to see the work that I had put in. I put some pictures up on Facebook one day just because like I was getting thumbnails done for videos, and I was getting stuff up on my website. So I was like, I'm just gonna get pictures. My wife's like, I don't need any of those in the house, because when last time I got really shredded, I got pictures. I put them up like we had an apartment that was almost like a date night pad because our kids were young, and I painted this wall red, and I put a picture up with me flexing, and she was more embarrassed than impressed, dude. She's like, that's not doing it for me, She's like, I get the real thing, so don't worry about printing any of these pictures. But I put them up there, and dude, when I looked at them, I was kind of surprised, like because I did a water drop. Have you ever heard of a water drop? So
where you like load up on your water and then you drop off of it so that it kind of all gets out of your body, tricks your body.
Yeah. So it's like a 10-day process, like 1 liter day 1, 2 liters, 3.5, 4.5, 5, all the way up to 10 liters by noon. And then you stop for 24 hours. So I stopped for about 27 hours, no water. I was so thirsty, but dude, it just makes you look, your skin's paper thin. So it's like, you see every ab, you see the whole thing. Well, then my wife is like, you're too skinny. So here I am, like, I put on about 10 pounds since then, still single digit. But yeah, she was like, you're getting too skinny. And I felt skinny, dude. Like I could feel my tailbone when I sit down.
That's like a stake to the heart though, for a guy. You don't call a guy skinny. That's like saying a girl's fat, right?
My skinny, well, you're too hard. She's like, you're just like, my chest was just muscle, right? And like, all right. So like, she wants it to be a little bit aside. This, she sent me this Instagram videos of being like the way women prefer their man, and it was like more like mid. It wasn't like totally buff, but it wasn't fat. It was like just a little bit squishy, which is
a little bit of dad bod, just a little bit.
I was like 14.7% body fat when this whole thing started, and I think that she liked that best, because I was still lifting all the time, but I was enjoying food and any kind of food to a certain degree for part of the time. Dude, I got to tell you, just having a food plan, like I just don't have to expend energy on what to eat. I just know what to eat. It's already pre-programmed, and I just eat. Before, I was doing all this intermittent fasting, which actually created a lot of cortisol in my body because it's stressing the body out. Like it's good for some people, not good for me. Now I eat within 15 minutes of waking up. I eat 7 times a day. And dude, I could eat 4,000 calories and still lose a little bit of weight that day. That's how metabolic I am now. And you know, I'm hitting the gym pretty hard, but nothing too insane. I used to do CrossFit. It's what I'm doing now is not that hard. Like I got tired of CrossFit. It was just super brutal, you know. Like I was just mentally exhausted after some of those workouts.
Yeah, just watching it like makes my my tendons and my ligaments and my joints, it makes mine hurt just watching people do it. You know?
Yeah, I had a buddy that owned a CrossFit gym. He came to work for me, and I had set up a gym at the house, so we worked out every morning. And he just pushed me. He was just in town visiting this last week, and we just did a nice little pump session that was way easier than the stuff we used to do. But you know, we used to get in trouble because we had these Echo bikes, which are like those old, you know, like you have the arms with it and the pedals, and it taxes you. And so we just tell people, get at least 30 calories in 60 seconds, and then you get a shirt. You get a shirt because we had it one for, and like 50% throw rate. So my wife is like, "What's wrong with you guys? Why are you torturing everybody, having them do all this stuff when they come over?" And I was like, "Yeah, there's something sadistic about us. We'll stop doing it." And so I just like doing a regular pump session now. And then I have a pool, lap pool in my house that's saltwater. So I've been swimming, which I don't love swimming, but it's supposed to be really good to like after all the detox of like you've been on electronics all day, been around your phone, all the EMFs, like swimming in salt water is supposed to really kind of help the body out that way. So I think it's good to kind of shape the back. So I'm doing that a couple times a week as well.
Yeah, I'm glad we touched on this to start, because I am a firm believer that if you don't have your health, you don't have anything. You really don't. Like if you're sick and bedridden, you can't provide value, so you can't make money because money follows value. You can't provide value to the marketplace. You can't provide value to your family. So health is so important. Like what we do, glad you mentioned this too, the EMF stuff. So I have EMF blockers on all of our phones. I've got EMF blockers next to my bed. Yes, you know.
Switch that you turn off at night, and it kills the power of most of the house.
Yeah. A lot of people turn their Wi-Fi off at night because you're just getting bombarded. If you're not using your Wi-Fi, why have it on? I've got grounding pads that I stand on to ground me to the earth. And it's so important, man. And then water, drink water. A lot of people do not drink enough water. So
sipping every 20 minutes so that you don't overdo. Like if you just sip it regularly, it's really helpful. You know, if you pound it, like I have a tendency to drink too much at once and you don't absorb it quite as well. But the other thing is not to drink while you're eating. You drink before and after, right? Yep. Otherwise you're messing with your kind of, now there's a lot of little things here, but here's what it all comes down to: genetic wealth. So, you know, legacy, we know that we want to pass on money without tax. We want to create a set of values and guiding principles to support so that it's not just an inheritance. It's a way to perpetuate wealth. But genetic wealth is a big part of this. Our healthy habits, our mindsets, you know, like epigenetics says there's all this thing that they used to call junk DNA. It was the unexpressed part of our DNA. And they're like, 90% of it is junk DNA. It wasn't that it's junk. It's just, it hasn't been influenced. And so everything from our mindset to the conversations that we have, to the amount of movement that we have, to the water we drink, to the sunlight we get, to the sleep that we get, and especially the food that we put on our body is part of that genetic wealth. And they've seen when we've stripped the nutrition too much out of the soil that people start to become more malnutrition. And it actually changes the shape. Like if you look at a lot of the Paleolithic like mouths, they were different than we are today. They were bigger, right? And they didn't have the cavities we have. But sugar is really terrible on even like the way that our face frames and the way that we grow. And so ultimately, when you look at it, genetic wealth is how do we get where we're eating the right types of food so that we have deep nutrient dense, you know, food. And then actually it's easier for people to get pregnant that way. I mean, you look at like in Switzerland, they have much healthier food than we have here in the United States, and they look different. It's starting to change. Like they have less birth defects. Like, you know, this is all something that Kate Shanahan wrote about in Deep Nutrition. And it's just, we've become overly processed and convenient. And it takes to be wealthy and it takes to be healthy a lot more intention and just dealing with the gravity of not just pushing a button and having your food show up. Like, dude, last week I killed an elk. with a bow, right? Now that's like a healthy meat. Like it's grass fed, there's no pesticides. It's just out there naturally. And dude, I had to carry that beast 3 miles in multiple pieces. So it was, 3 miles in to get him, 3 miles packing him out, 3 miles in, 3 miles out. Like, I'm certainly going to appreciate that food at the very highest level. It wasn't just pushing a button and automatically having it show up. And some people don't love the thought of killing animals. But if you eat meat and you're pissed at me for killing an animal, then I guess you're like a mob boss. You don't care where your food comes from. You don't want to know, but you're fine with it being murdered as long as it's not you that pulls the trigger,
Honestly, man, like there's some things where when you do it, you just feel like more of a man. Like what you just described, killing your own elk, carrying it back, cooking it up, like that just probably made you feel good, right?
Dude, killing it up with a bow is a process. I mean, it's work, There's like a lot of practice that goes into it. And then my bow wasn't working right. The arrow rest that pulls up wouldn't stick. So I had to pull the back and it kind of pulls it up, but it's sticking. And I'm trying to shoot this animal that's I'm trying to hide from, and it's, coming in. It was a hell of a process. And then tracking it down. And I mean, it's an adventure, and it's also work, man. Like I had to have mantras in my head to pack 100 pounds on my back for just one hindquarter for 3 miles and not rest. I was like, if I rest, it's going to take longer, and I don't want the heat to ruin the meat. So I was like, Dory was in my head from Finding Nemo, just keep swimming. But I was saying hiking. I was thinking about I was thinking about David Goggins saying you got 40% more in you, and I was like, I could just keep going, one more step, and like that's a hell of a process for sure. And it was also a good time with my dad. And I like to hike with purpose, and I like a lot of time to think and just get some time to be in nature.
Was this the first time you had done that?
I've killed 3 elk with a bow that are bulls. I've killed 1 bull with a gun, and I've killed 5 cow elk with a gun. So I've like we eat a lot of elk meat in my family. Like my parents just dropped the meat off today because I dropped off most of it at the butcher, and it just got done.
Was part of that the inspiration for the title of Killing Sacred Cows?
I hadn't ever killed an elk when I wrote that book.
Okay.
I'd never killed an elk. What happened was I was in a library meeting with my ghostwriter at the time, who became the co-author. I was like, "You ready to kill some sacred cows?" And he was like, "Dude, that's the title of the book." So I was just, like we were just coming up with what are all the myths that are out there. And I was thinking through, like, what are these myths that people buy into that are holding them back? And I was coming up with like statements and cliches and conversations I was thinking about, and then just taking what the most common ones were. And those are definitely sacred cows. They're unquestioned beliefs, just like from the Bible when they're like, they were worshiping these sacred cows. And that's kind of how it is. Like what a sacred cow fiduciary is too. That's the new one that I would write about. Like, oh, I am a fiduciary that's got my best interest in mind. I'm like, guess what? They put the douche in fiduciary because all they're really doing is getting a fee on your money. And if they were really a fiduciary, they wouldn't charge you if they were making you money, or there would be more advice than just a bunch of mutual funds. Like, I don't consider that to be like a great standard. I think it's a great story, but not a real standard.
Right. I went down that rabbit hole right when I learned all this stuff about infinite banking and whole life insurance. Right beforehand, I got sold on an IUL, actually 2 of them.
I got VUL, bro. VUL was when I was...
Oh, even worse.
Yeah.
So IUL, I got sold on by a fiduciary. So I'm thinking, oh, he's my fiduciary. He's got my best interests in mind. This policy, 2 policies, I was putting in $18,000 a year for 3 years, 0 cash value because of surrender charges.
Yeah.
So that's not good for what I was looking for. I was looking to use money right now, but let's talk about that a little bit. Like whole life insurance, that's what we both believe infinite banking should be used with, not an IUL. Let's talk about why.
It's possible to do it in an IUL. It's like an IUL has so many problems that people don't understand. But if you just read the document that's 25 extra pages or 75 extra pages over a whole life contract, because they can change the spread, which is, how much you're actually netting. They could change the cap rate at what point you participate, or they could change the participation rate on what percentage of the upside you get. So they have these three factors that they can move, and those are movements really outside of their control. Because when they, look, ULs were super popular in the 1980s because there was double-digit interest rates in a CD or money market. It was just so people thought, oh, I'm going to buy this and have millions of dollars in the future. Guess what? They didn't, because interest rates came back to earth, and they've been low for a very long period of time, all the way until 2022. So ULs fell out of favor, especially in the 90s, because in the 90s, interest rates were low, but the stock market was really going well. And so VULs were the answer. Hey, get into these sub-accounts. You're going to get what the market gets, and the market's going to only go up. And when I was sold, they showed me 18%. That's illegal. You're not allowed to show more than 20%, 12%, and even 12%, showing 12% a year in and year out. That is ridiculous. That is impossible. That's never happened. It's never going to happen. Yet that's what the illustration is showing. So to show on an Excel spreadsheet at $70 a month that I was going to be a multi-millionaire by the time I'm this age right now, that was not realistic. And I was taking an econometrics course in college, and I started to do this study as like this variable analysis using Monte Carlo experiments and seeing different times in the market with different volatility. And what I found was, at the level I was funding the policy, it wouldn't work 97.8% of the time. Not that it wouldn't have millions of dollars, it just wouldn't work, because not only do we have, like what I talked about with the IUL problem, in VUL, you have a different problem. That is that when the market goes down, your net amount at risk, which is how they charge you, is they take the death benefit minus the cash value. That's the net amount of risk. That's how you get charged. Well, when the market goes down, you have your increased charges while your accounts are going down. So you're actually having to redeem more shares to cover the cost, creating downward pressure that's like a double dip. And so it's a major, major problem. So VULs, they were in favor in the 90s. They kind of went out of favor. IUL was like people shrugging their shoulders and like, I don't know. We don't know what the market's going to do. Interest rates. So let's just do this thing that says downside protection with upside potential. The problem is, where's the downside protection if they can change the cost of insurance? So we have, one, your mortality. So the older you get, the more likely you are to die. And so it's built upon a term chassis of annual renewable term. And so every year that you keep that policy, the cost of insurance is going up. And it's typically 20% more expensive than term insurance, because they can hide it inside of this cash value chassis of IUL. So you have the upside potential that might not be what you thought because of the three things I mentioned: spread, which is, at what you have to subtract before they say this is what you get. That's the cost. Or cap rate, saying, hey, if the market does 20 and we're capping you at 10, or the, participation rate, which might say you get 70% of whatever the market does, right? So they have these layers and levers based upon the way they make these perform. Is they take the money that you would have gotten a dividend in life insurance, and instead they buy an option. And that option is based upon how competitive options are. If the market's really volatile, options get pretty competitive. And so the reality is you might not be able to buy as much of an option, which means they're going to lower your cap rate so you don't have as much opportunity for the upside. So what if you've been running this at 8% a year, but some years are at 0 and some years are at 5, and the top that you could possibly get is 7.6 some years because of those cap rates? Well, that's a problem. Now you're completely off on your projections. But here's the worst situation. If you're healthy, you're going to move and get a new insurance policy because IUL is constantly coming out with new bells and whistles and better policies. Hey, come do this policy. It's better than your old policy. We've got accrediting. We've got a bonus. We've got better participation rates. And so people jump ship and they go to the new company because there's a lot of churn in this. But then the people that are unhealthy get stuck with the old policy because they can't qualify for the new one. And then what happens is more people die per 1,000, raising the cost of insurance because they can raise the cost of insurance from the current to the guarantee. So you have the upward pressure of insurance expenses rising as you just get older. You have the pressure of the more people die and the more the experiences versus what they projected, the higher the cost of insurance. So you have these two things that are hard to see because you could see the participation rate a little bit easier. You can see the spread. It's easier to look up. But if you're like, well, what are the cost of insurance? Did it go up? And what's the impact on my net? They might say, oh, the market did -10, but the good news is your credit is 0. Well, it's 0 minus your expenses. You still have to pay for those costs of insurance. And if you don't make it, because the cost of insurance is rising and the participation rates or the cap rates aren't what you expected, if there's a certain time where you don't have enough money in the policy, you have to actually contribute more. And if you don't contribute more, the cost of the policy wasn't a write-off, and you could end up paying taxes when that policy lapses. That is crazy. And people are buying these because they're being sold as, hey, you get to participate in the market, but you'd be better off just putting your money in the market. The stock market, I'm not a fan, will outperform indexed universal life in any long period of time. Any 20-year, 30-year, 40-year period of time, it's going to crush IUL. IUL might win over a 5-year period of time or a 7-year period of time or a 10-year period of time, because we might have 3 down years, back to back to back in the stock market. Or we might have a time where it's a little bit more anemic and it's more like 5 or 6% for a few years. There are short periods of time where it might make sense, but long periods of time, you're now putting your money at risk. And if you don't hit to this place called the lapse guarantee period, if you don't get your policy to that, when it lapses, it's a taxable event. I mean, that's nuts. So why would anyone do this? Because they have salespeople selling it to them, not knowing what they're doing, not telling the whole story, not analyzing these policies. I would urge anyone selling at IUL to go back to when they were invented and to look at the first policies and see what the cost of insurance is. It's at the guaranteed level, not at the original projected level. That is massively different. If you look from the beginning, this would never happen. If they started to charge the guaranteed from the beginning, it eventually zeroes out like in 20 years by funding it the way most people fund it. So that wouldn't happen. It takes time for that cost to increase, but that's a crazy place to be and a very dangerous place to be. So why would you take this capital that could be in a risk-free arena? And by the way, whole life insurance over 30-year periods of time using a participating mutual company over any 30-year period of time has beaten bonds, money markets, treasuries, all of that. You have more cash on cash, but you also have a death benefit. You also have tax advantages. You also minimize capital depreciation. You don't have, when interest rates fluctuate, it doesn't lower the value in your account. You've got benefits that you can add to your death benefit that allow you to benefit while you're alive if there's unforeseen circumstances that are, like long-term care or terminal illness. Like, there's all these other factors, but you're going to lose out in the first few years because they need to set money aside for reserves. They need to have, for the few people that die, money set aside to handle that. So yeah, it's going to be less cash initially, more cash long-term. And if you use it as an allocation towards your fixed income portfolio, towards cash value of whole life, instead of towards money markets, bonds, that kind of stuff, that you're just going to be better off long-term. And so IULs are now chasing some number that's not real, getting people to buy into the hope and the hype that, hey, this is going to work out when it's not. I mean, it's going to be a black eye to the entire industry when these policies totally implode and people feel like they got screwed over. Surrender charges is my first problem. There are no surrender charges in whole life. Whatever your cash value is what your cash value is. At IUL, it's like, oh, look at the money you have, but you can't get to any of it. Well, what good is it then? Is it really money? Like it's phantom at that point. And so I just don't like, I mean, obviously I'm passionate about it, giving a lot of detail here about it, but that's the issue.
I think that's the thing though, is a lot of detail needs to be given because people need to be informed. People buy IULs and they're uninformed on how it works. They think just, oh, there's a 0% floor, so you can't lose money, quote unquote. But to your point, if there's no growth and there's a ton of costs because of cost of insurance, how does that get paid? It gets paid by either your cash value, but if you're using infinite banking, your cash value is out working. It's in an investment. It is paying debts off. So if you don't have cash value in the policy, you have to inject more into the policy just to keep it from lapsing, just to keep it alive. That never happens with a whole life policy. The cost stays level, never goes up, guaranteed contractually, same as day one as day 85, whatever it is. And then the growth never stops, guaranteed plus dividends. So I always tell people, like, an IUL is like making insurance an investment. It's not an investment. It is a savings vehicle that gives you extra benefits. So if you use an IUL for infinite banking, that does not work.
Right.
Use what you know is going to work, what's steady Eddie, what you can predict with certainty. That's what you should use for banking. Investment and banking should not be mixed.
Yeah. And I mean, an IUL is a bad investment if it is an investment. It's just,
Right.
it's going to underperform and it has a whole bunch of risk. And just saying that it's because it's going to save you tax, it's probably not going to save you tax.
Here's the one way I think an IUL might make sense. Tell me what you think about this.
Right.
Is because it's based on a 1-year annual renewable term, like you said, every year the insurance portion renews. So every year you get older, you're more expensive to insure. If you're super young, you're not expensive to insure. So I think it would make sense to have an IUL on like a child, put money into that, hopefully grab a little bit more of the upside. And then once that surrender period is over, let's say you get the policy when they're a year old, surrender periods are usually 10 to 11 years. So let's say by the time they're 12, cost of insurance is still really, really low. There's no more surrender charges. So now your accumulation value is your cash value.
Yep.
At that point, 1035 that into a whole life policy built correctly. That's the only time I really think an IUL makes sense. What do you think?
Well, the issue to still consider there, I would agree that it doesn't make sense to keep it to life expectancy. Because what happens when you take money from the policy? You have to look and see, is it pulled from the policy? How's the wash loan work? All that kind of stuff. And does that impact the cost of insurance? That's a big question to ask. And company to company, it's a little bit different. But what happens during the kid's life with spreads, cap rates, and participation rates? That's my concern.
Yeah, those three factors they can adjust.
Yeah. So that's my biggest concern is it's giving all your control to the insurance company.
Yeah. Someone told me too, they're like, and this made so much sense. It's like within whole life, they have a pool of money. It's their general account, right? Billions and billions of dollars. Every time someone pays a premium, it goes into that general account. So the insurance company has to take that money and go make more in order to pay death benefits, guaranteed death benefits they're going to pay out. So you can look at insurance companies and see what assets they have, what their portfolio is.
Right.
If IULs were so good, why wouldn't just the company take and do exactly what they're doing in IULs? If that was a place where they'd make so much money, right, buying call options, why wouldn't the companies do that? They don't do that. They do long-term treasury bonds. They'll lend blocks of money to different institutions. They don't do what an IUL does. If it was that good, the companies would do that with the money.
And look, an IUL is a really good deal for the insurance company.
100%.
Because they have a lot of control. There's a lot of levers they can pull. They've got the guaranteed cost of insurance. They've got the cap rates, spread, like all that. It just puts them in a much better situation. Now, let's just say I'm selfish and I don't care about the world. IUL helps my whole life perform better. Because
True.
Ultimately, people that buy term insurance and IUL, 98.9% of term insurance doesn't pay out, which means those dollars go into the general fund, and as a participating policyholder that owns whole life, the dividends come from the performance of that fund. Yep. So it's not just the bonds that they buy and how they allocate those funds, it's how the IUL and term and all that brings in money too.
Yeah, that's true. I think it's a mutual friend of ours, Chris.
I'm in New York yesterday, man. I'm getting I'm definitely, I wake up too early when I'm on the East Coast and all that kind of stuff. So I didn't mean to yawn.
No, all good, guys. Garrett just spoke in New York, right? Yesterday.
Yesterday to a bunch of insurance advisors, actually.
little bit of jet lag, so no worries, brother. A mutual friend of ours, though, Chris Kirkpatrick,
Yeah.
he actually says that an IUL is actually a profit center for the insurance company.
I just wrote the forward on my flight back from New York for Chris's new book, IUL Exposed. So,
Oh, I can't wait to read that one.
Yeah.
I can't wait. Let's actually talk about this book, man. This book changed my life. I actually have two trusts now. I have a family trust. I have a business trust. I have a management company that everything funnels down through, and my policies are owned by my trusts. It's changed my life and how I view things. I always thought like life insurance and trusts and all that stuff was for old people. That was my thought process.
Dude,
Right?
I just wrote a blog where I use the word like, hey, legacy isn't just for when you're old, like, because isn't that how we're conditioned to think?
Yeah.
Hey, I'm old. And what's interesting is how many people are told to buy term and invest the difference when they're young. And then when they're old, an attorney goes, you need to buy some whole life. And it's like, why did I buy it a long time ago when I bought term, when they said I wouldn't need it? And now I have an estate tax problem. And now they tell me to buy it. Like, isn't it interesting, the juxtaposition there?
Yeah. Well, let's talk about this book then. How did this book come about? Like, what gave you the motivation to write it? And we'll dive into that a little bit.
So that book, I mean, kind of lucky because one, when I have my hair down, people say I look like Jesus. I got a lot of gray hair. I live longer than Jesus lived, but they'll say, what would Garrett do? Like in just like, what would Jesus do? And I was like, what would the Rockefellers do? I said one day. And I had been doing a little bit of writing about the Rockefeller family and knowing that they had passed on wealth for generations. And I had stumbled across the story of like the Vanderbilts decimating their wealth and not having trust and not using insurance and not having a family office. And so I was already writing this book and had to completely start over once the name What Would the Rockefellers Do came. I was like, yeah, that's the conversation. Let's see the difference between the Rockefellers and Vanderbilts. And let's see about other people that did what the Vanderbilts did and how it's been able to help them perpetuate wealth. And of those things, what applies to the masses? Because I wrote that book to make legacy accessible to the masses. Most people think legacy is for the highly affluent, it's for the hoity-toity, it's for the people that have already got, ultra high net worth. But I think legacy is something that I started thinking about at 19 years old. Bought my first house using a champ loan for the down payment, had my parents co-sign, rented it out to a couple college roommates, and I started to build wealth from an early age, right? And so I was like, all right, what does this mean? And how do I capture this? And what do I do to preserve this? And in asking a lot of questions, I ended up buying a $50 a month life insurance policy, right? Just a really, really small $100,000 death benefit, just to understand how it worked, because I had already invested in the stock market and was pretty disenchanted because in, the year 1999, anyone could make money. In the year 2000, no one was making money. And it got me to ask totally different questions. And so in that path and asking those questions, I started to discover, some of the things the ultra wealthy were doing. And so one was they were really good at tax, but two was they're really good at like having liquidity. And you would see I'd see articles back in 2019 that 37% of billionaires' money was sitting in cash equivalents. And then I would hear about corporate-owned life insurance and bank-owned life insurance. And I talked to this guy from King of Prussia, Pennsylvania, that had sold Donald Trump an insurance policy. And I was just fascinated at an early age, being like, why are the wealthy using this and how are they using this? And as I started to write this book, this woman, Sheila, that was a CPA for the Rockefeller family, reached out and said, this is exactly what we do. And is there any way that your firm could help me do it for myself? And so I was said, sure, if I can ask you a bunch of questions and quote you in the book. And she says, absolutely no problem. And so it was really my co-author, Michael Isom, was getting a bunch of leads from us. We had this firm, Wealth Factory, that I sold. And at the time we were generating a lot of leads that were helping people build out their financial house. And we wanted to refer them to people that were experts in each area, attorneys, accountants, and insurance people being one of them. And all of a sudden my firm stopped sending him leads. And I didn't know about it. And so I was kind of pissed because he's really good at what he does. We're really close friends. And so we sat down between December and just before January of 2016. And I was like, let's write a book. And so we decided to write this book. And dude, I can't believe how popular this book is. When we wrote it, we didn't know, right? There's almost 2,400 reviews that are just organic reviews. I've never asked for a review on Amazon. 4.6 for a book that's heavily about insurance and trust. And just understanding the difference between the Rockefellers and Vanderbilts is super helpful for anyone that wants to know what's going on. And I think it's pretty straightforward on how to use insurance. Like a lot of people are like, I always hated insurance, but now I read this book, I understand it, and I want to do something with it. So I think that we've been pretty instrumental in helping a lot of people focus on legacy that wouldn't even think about it, and get insurance that didn't think about it either. And look, when I started selling insurance 25 years ago, I used to be bring it up and wasn't sure what people's reaction was. Now I just expect everybody's reaction is going to be really good because we've got a lot of good books out there. We got a lot of good people putting out content on a regular basis, and people know a whole lot more about insurance than they did. It's just unfortunate the IUL people are coming in and fucking that up. They're coming in and ruining it because they're taking this really great tool and this really great resource and they're bastardizing it because the numbers potentially look better, but the numbers aren't real. And so we have a completely different problem now than when I started, that almost no one really knew that much about insurance and how to utilize it back then. And now people are hearing about it, but hearing about the wrong type of insurance, and it's going to be a problem for them.
What I really like about this book, guys, and what I would definitely recommend reading it, is it starts off with the story of the Rockefellers and the Vanderbilts. So to Garrett's point, just knowing the difference between those two families is really important. And if you just, I think it's literally the first chapter is literally just telling the difference between the two. The Vanderbilts blew all of their wealth within, what was it, 2 or 3 generations? 2?
So when Cornelius died, his eldest son doubled the estate in 9 years, then he died. And it never grew again. It just decimated from there. It was 54 years after his son's death that the first Vanderbilt died from.
And Vanderbilts had more wealth than the Rockefellers at the time.
As a percentage of wealth in all the circulation of money in the world, I think the Vanderbilts might be the richest of all time if we don't count the Rothschilds. The Rothschilds are harder to find information on, and they're the ones that own most of the federal banks, the central banks. So you don't hear a lot.
They probably own BlackRock, and
there were trillions for sure, but it's just kind of behind a curtain, so you don't really know. But yeah. Vanderbilts had a global shipping enterprise, and they had more money than the U.S. Treasury. That's how much money they had.
Dude, so knowing that difference, guys, between the Vanderbilts and the Rockefellers is huge, because the Rockefeller family has perpetuated the wealth and grown it over, I think it's 9 generations, right? Which is insane. So knowing how to just do that is important. And this book outlines it in a simple way where trusts are super important. Insurance is super important. However, most people find it very boring. It's not fun stuff to talk about or to hear about, but the people that become the wealthiest in this world, the people that become the most influential, they do little things, like I said, consistently. So I love this book, man. And I'll tell you, out of those reviews, I think a lot of them might be accredited to me, because I tell every client that I've had, read this book. Read What Would the Rockefellers Do? I have everyone read The End Asset. I have everyone read Becoming Your Own Banker by R. Nelson Nash. Those 3 books, I think, are staples. Guys, if you want to learn more about infinite banking, read those 3 books. So, dude, this book is incredible. Where can people find it?
Amazon, or they go to my website, GarrettGunderson.com. Click on books. It's there.
We'll put that in the notes so that people can get to it. Yeah. And then people can follow you on social media, Instagram, all that stuff.
Yeah, I'm finally doing some Instagram these days, like 3 videos a day. I'm slow to the process. I was doing a lot of YouTube back in the day. Got a little bit tired of it, but I am doing a little bit on Instagram, and I am fairly active in my DMs, so when people reach out and stuff. But yeah,
guys, go follow.
It crushed TikTok, man. Right? Like you're the guy that figured out TikTok pretty early on.
Yeah, December of 2020. My 3rd video was me in my car talking about how to get all the money back for any car you'll ever buy, drive, and own. It was talking about how to use a policy. I went to bed, woke up the next morning, I had 20,000 followers overnight from that one video. So I just kept making videos like that about infinite banking. But I like your content, man, because you add humor to it. You're actually a stand-up comedian.
Yeah, there's a comedy special on Amazon Prime called The American Ream, REAM, and it's me doing money, doing comedy around money, which not much of that out there. So it's like 90% laugh, 10% learn. It's not a whole lot of there's just a few nuggets in how people think, help them see things a little bit differently.
I like that. So guys, think about this. Any economy, it doesn't matter what it is, the industries that are always doing well is entertainment. People will pay for entertainment even if they're broke. They're going to go to a sporting event. They're going to go see a movie. They're going to go whatever, right? So if you can find a way to entertain people and then intertwine education, most people don't want to educate themselves. You can entertain yourself or you can educate yourself. Most people want to be entertained. They don't want to be educated. If you can find a way to educate while you entertain, which is what you do, and I think it's so smart, that's when it really sticks. And that's why I like your content, man. You throw some humor in there. I think you could do more humor because, dude, you're freaking hilarious. I remember when you spoke at the And Asset Mastermind a couple years ago, I was dying laughing. So
yeah,
everyone go check out The American Ream, REAM on Amazon, right?
Roku, Tubi, those both have it as well. So it's streaming a few different spots out there.
Love it. So we'll kind of gear up for the ending of this. We're coming to the top of the hour, but if you could, some people that watch this, they know about infinite banking. I talk about it a lot. Easiest way possible. How can you explain what infinite banking is?
Well, look, I'll just explain it the way the Rockefellers did this. They buy life insurance on everyone that's born into the family. And then they use a trust so that when that person dies, it funds the trust. And they don't even have to use the banking system because they've got all their own money inside of a trust. They can get preferred interest rates to all of their heirs. And they can use the cash value of the policy along the way if the right investment opportunities come up. But if not, it's a stable, safe, secure place to store it that's tax advantaged. They get access tax-free. And that death benefit actually becomes extraordinarily valuable because it replenishes that trust in case there's inflation, taxation, or interest rate fluctuations. And so it gives them a bit of resilience and buoyancy, which is part of the reason they're moving on to their seventh generation. So this is something that, look, I could give an example. Back in the day at GE, they used to, in the 1950s, they wanted to be the number one or number two in every category. And they weren't number one or number two in every category. So they're like, to make that way in these divisions, what are we going to have to do? They're like, we're going to have to hire people that are number one and number two at other companies, that those companies are our competitors doing better than us. So how they did that was they used kind of infinite banking. They said, all right, we're going to recruit them over to work for us. And if they work for us for at least 7 years, they'll get a pension. The day they start working for us, we're going to buy life insurance on them, whole life insurance. That cash value will supplement that pension. Depending on how long they live, it might cover the pension. If they live longer, it'll supplement it, right? But when that person dies, that death benefit will come back into GE and pay them back all of the money they paid them, plus a small rate of return. So all that salary that it is going to take them to become number one or number two in these categories and recruit the talent and give them a pension would be recovered when that person died because GE would be around longer than that individual. And they did well with that for decades until Wall Street came and convinced them otherwise. They said, guys, why do you care about a 3 to 6% tax-free return when you could get 12 to 18% because the market's going nuts in the 90s? But for those that have been around and have read much, what you have to understand is variable accounts or volatile accounts risk being depleted if you take more than 4%. So they could take more than 4% because it was guaranteed inside of these cash values and be replenished by the death benefit. You can't take more than 4%. And when they did take more than 4%, because when they were good years, they took their fair share and paid their employees. But in bad years, they couldn't take any, and it depleted the accounts, destroying and making the pensions bankrupt. So this is a lesson from GE that we've watched the Rockefellers do in their own family. Just like GE want to be an ongoing concern and a company that would last for generations, the Rockefellers said, what can we do to be a family that lasts for generations? We'll buy insurance on everybody that's in the family. The death benefit will come back in on whatever amount that they've made mistakes or taxed or utilized that didn't get paid back because a business struggled or didn't work out or there were heavier taxes than we expected. And so the difference between GE and the Rockefellers is GE decided to go take a bunch of risk on their money. The Rockefellers continued to use this, and they take risks in their own pursuits, not outside speculation. So this is a stability play. This is access to capital when it's required or needed. And so you can capitalize on great opportunities, or a place to preserve and protect your money when there isn't a place to allocate it because times are just maybe not the right time. And so that's kind of the Rockefeller wrapper on it. And I've got 28 policies now, I think. And, that includes policies on my kids and on my wife and on employees and all of that kind of stuff, and a lot on me because I started small and then grew and had a lot more wealth. And so I started buying bigger policies over time. And I don't have any money in bonds. I don't have any money in stocks. I don't have any money in the stock. I don't have any money in the bank other than to pay bills. I have 30 days cash in the bank. That's it. It's just so I could pay payroll. It's just so I could pay basic bills. Everything else is in my cash values. And then I've used my cash values to buy the real estate that I'm in here. I've used it to buy other properties that were in high demand that there was a lot of people trying to buy, but I was able to close in 5 days or 9 days. And so I've used it to capitalize and get deals I wouldn't have gotten done otherwise because I had access to that capital. I think everybody's in store for 20 great opportunities in their life. They just watch 19 or 20 of them pass them by because their money's locked in a 401k. Their money's not available or accessible to them. Or the stock market's down and they don't want to cash out during that time because it's a guaranteed loss. Well, we don't have to worry about those losses inside of an insurance policy. It's my savings account. It's my asset allocation for all my fixed income. I put 15% of all my income through it, and I use it when the opportunities are amazing, and when they're not, I let it just grow inside of it.
You made a good point, man, about liquidity, right? Liquidity matters. It really does. The wealthiest people are liquid. They can jump on opportunities. And if you've got a whole bunch of money sitting in the bank as your liquid funds, someone could take that on a judgment or a lawsuit. If all your money's sitting in a policy, it's protected against lawsuits and judgments in most states. So there's creditor protection, which is something a lot of people don't realize.
Yep.
So it's a safer place to store capital. There is bank upon bank upon bank that go under. Insurance companies don't go under. And if they do, they just get bought up by another insurance company and your contract is held in place still. So, dude, I tell people all the time, don't chase the shiny object syndrome. The IULs, the VULs, all these things are shiny objects. Whole life insurance has been around since the 1700s. It works. You know what I mean? It works. The Rockefeller family uses it. The wealthiest families use it. Ray Kroc with McDonald's used it to franchise McDonald's. Pampered Chef, Walt Disney, the list goes on and on. And I think there needs to be more people like you really educating, putting out the books, putting out the content so that people can realize that legacy is possible. And you also touched on legacy is not just your wealth. It's your mindset, it's your beliefs, it's your healthy actions. There's a part in this book that talks about that. Building out what you actually want your legacy to stand for and having that within your trust. So, guys, can't say it enough. Check this book out, read it. It'll change your life. It's changed mine. Dude, I appreciate you being on, man. It's been fun. Fastest hour of my life.
I'm a talker. Doesn't take much to get me going, does it?
I'm the same way, dude. So let's leave people with just a little nugget, like a little word of advice. Maybe if you could go back to, talking to 18-year-old Garrett, what would you tell him?
I would have done a lot less investing. at 18. I bought a property and casualty company, a mortgage company. I did done a bunch of real estate. And I would have just said, pick a lane, know your investor DNA, which is your values, it's your competencies, it's what drives you. And you're okay just leaving money in your cash value for time periods as you grow your business. Your business is your great asset anyway. Don't worry about, I had oil and gas deals I did hard money lending funds. And all of that just took up so much time. And the only reason I did it was greed. Now I look back and I'm like, is this really valuable? Does this help me build relationships? Does this make me feel connected to my audience? My investments are my books. My real estate is my books, or it's the stuff that I go and tangibly benefit from and enjoy myself. And so I would have just simplified and saved a little bit. Like I saved so much money and then blew it on tons of real estate, because when it was 2008, hemorrhaged through a lot of that. But at the same time, I learned so many lessons. I just would have liked to be able to tell myself those lessons rather than go through the lessons and be like, hey, look, I'm coming from the future. This PNC company, distraction. This mortgage company, distraction. These 100+ properties, distraction. Stick to what you know and what you love. Like when I write a book and I get to know you because of what I've written. It impacted you. We have a relationship because of that. You don't care about the real estate I did. You don't know anything about it. It didn't impact you in any way, shape, or form. Like I got a gift to write, so I want to continue writing. And that would have been the main piece of advice.
I like that advice. I like that message because so many people try to do too many things, right? Instead of being an expert of one thing, they try to be a jack of all trades. So I remember when I was putting out a lot of content about infinite banking, I was doing real estate, and then I started using infinite banking to fund the real estate. And then I just started talking about infinite banking all the time. I remember people would be like, dude, do you talk about anything else? And I'm like, no, why would I? This is my lane. This is what I'm focused on. And I've built a business now where we've served over 3,000 clients. And I'm one of the top producers in the nation now, which is insane. I didn't even think I needed life insurance 4 years ago. I thought it was for old people, So just stay in your lane, guys. So much wisdom from Garrett. Follow him on all the platforms. Go check out his book. We didn't even talk about the other one, Killing Sacred Cows. We briefly did, but that one's great as well. I've read that. Share this episode with everyone you know. Anyone that you feel can get value from what was talked about today, make sure to share it and pay it forward. Until next time, I love you guys. Peace.